Your token is up 100% in one day. Is that good or bad? Don't rush the answer. The correct answer is you don't know, because price by itself tells you nothing. A 100% jump can be a sign of healthy demand, or it can be a sign that your order book is empty and a single $100 order moves the price wherever it wants. Today, I'll teach you how to read the market. My name is Max Moris. I'm CEO and co-founder of Cicada. Our main focus is market making. I've been in this business for over 6 years, and in that time I've worked with hundreds of tokens. Today we break down the anatomy of a healthy market, the order book, the spread, the depth, the volume. After this video, you'll be able to open any tokens market and tell within a minute, is it alive or artificial? Let's start with the foundation, the order book. The order book is every buy and sell order in one place. At the bottom, bids, the buy orders. That's demand. At the top, asks, the sell orders. That's supply. In the middle, the mid price, the market's balance point. A few terms you need to know. A limit order is an order that sits in the book and waits for its price. A market order executes immediately at the best available price. Whoever places a limit order adds liquidity. They're called a maker. Whoever hits the market takes liquidity. That's a taker. Exchanges treat them differently. Makers and takers pay different fees. Makers pay less. And here's the thing. The order book is not a static picture. When the price rises, new sellers appear in the book that you never saw before. When the price falls, liquidity disappears. Buyers pull their orders. Why does this happen? Some traders place hidden orders, orders that trigger when a target price is reached. Example, I want to sell Bitcoin at $100,000. I can place a hidden order in advance and it will appear in the book only at the moment the exchange price hits 100,000. Until then, nobody sees it. The first health metric, the spread. The spread is the gap between the best buy price and the best sell price, between the best bid and the best ask. Why it matters? The spread is your cost of getting in and out. You buy at 100, you sell at 50, you've lost half your money with nothing happening. Nothing happened. The spread was just 50%. I'm exaggerating, but the mechanics are exactly that. The norm for a liquid pair is tenths, sometimes hundredths of a percent. For smaller coins, up to 0.5%. Anything above 1% is a red flag. Liquidity is thin, every entry and exit is expensive, and traders simply avoid that market. The spread is the first thing a professional checks when opening an unfamiliar token. One number, and you already have half the diagnosis. The second metric, depth, the most important block of this video. The spread tells you the price. Depth tells you how much that price can take. And when people talk about a token's liquidity, they mean exactly this, the depth of the order book. Depth and liquidity are the same thing. Depth is the volume of orders sitting in the book at different levels from the current price. The levels to watch, 0.5%, 1, 2, 5, 10. The key level that exchanges and aggregators look at is plus minus 2%. How many dollars are sitting in the book within 2% of the price? Why you need this? If there's $1,000 at the 2% level, a $5,000 order punches through all of that liquidity and the price jumps. That's slippage. You wanted to buy at $1, your average fill came out at $1.20 or worse. The thinner the book, the harder every trade hits the price. And the most dangerous thing, the liquidity gap, a hole in the book. Orders sit down to minus 2%, then nothing, and the next liquidity is at minus 10. One large market sell falls through that hole and the price is instantly down 10%. That's where vertical candles come from. That's where flash crashes come from. That's where community panic and what just happened come from. Nothing happened. There was a hole in the book. A healthy market is a book with no holes. Even liquidity across all levels on both sides. A market maker's job is to build that evenness and hold it around the clock. The third metric, volume. The main rule here, seeing isn't believing. Volume is how much was traded over a period. A big daily volume number looks convincing. The problem is that volume is the most easily faked metric in the market. Wash trading, you buy from yourself, you sell to yourself. Volume grows, there is no market. That's how gray market makers operate. No licenses, no legal entity, no reputation they'd be afraid to lose. But here's what you need to understand in 2026. The era of painted volume is ending. A few years ago, wash trading was everywhere. Today there's a fraction of it. The reason is banal, it no longer works. Traders have learned to tell real volume from fake in seconds. Real volume always comes together with real depth and a tight spread. If daily volume is $1 million and the book holds $300 at 2%, no expertise needed. There's volume, there's no market. Exchanges are actively fighting it too. Fake volume damages their own reputation. And 2 years ago, several market makers were arrested for market manipulation, including volume inflation. The industry has grown up. What used to be a gray norm is now a criminal case. One more check takes a minute. Open the trade history. Modern wash trading isn't done with big blocks. The opposite, with many small identical orders inside the spread. A buy and a sell of the same size again and again at a steady interval. If you see identical paired buy and sell orders constantly appearing inside the spread, you're most likely looking at fake volume. Real trading is chaotic, different sizes, different timing, different prices. Fake volume is rhythmic. A live market looks like noise. Fake volume looks like a pattern. The takeaway. Volume without depth is decoration. Check the combination. Volume, depth, spread, trade history. Together, they don't lie. Let's pull it all into a checklist. Open your token's order book and run 6 checks. 1. The spread, 0.1% for liquid pairs, up to 0.5% for smaller ones. Above 1%, red flag. 2. Is there real depth at plus minus 2% on both sides, and at 5%, and at 10? 3. No holes in the book. Liquidity is even. No gaps between levels. 4. Is the volume backed by depth? Does the ratio look plausible? 5. Is the trade history chaotic? Different sizes and intervals, not identical paired orders inside the spread. 6. Is the book symmetric? Bids and asks balanced, no heavy skew to one side. 6 yeses. Your market is healthy. Even 1 no. Your market has a problem and it won't fix itself. It's like a cavity. The longer you ignore it, the more expensive the treatment. The full checklist is in a PDF, link in the description. Save it and check your market once a week. To wrap up, price is what everyone sees. The order book is what professionals see. Anyone can paint a chart, a healthy order book. Only a real market or a good market maker. Now you know how to read it. Spread, depth, volume, trade history. 1 minute in the order book will tell you more about the token than an hour on the chart. I'm Max Moris, Cicada. If you want us to look at your market and tell you honestly whether it's healthy, reach out. I personally review every incoming request together with my team. In the next video, why your token can look alive without being alive. The illusions of an active market and how to spot them. Subscribe.